Hello everyone, my name is Bagas Mukti Wibowo, and today I'm going to explain a critical topic in financial management, which is managing current assets. Specifically, I'll be analyzing the company Pakuwon Jati, a prominent property developer in Asia. I'll explain the importance of managing current assets, provide a case study of Pakuwon Jati, analyzing the company current position in managing its current assets. First, let's understand why managing current assets is so vital for any business. Current assets include cash, accounts payable, and inventory. These assets are critical to the financial health and operational success of any business. First, cash. Cash is the lifeblood of a business, and its proper management is crucial for liquidity and operational continuity. Why is cash management important? First, for liquidity maintenance. Cash is essential to meet immediate obligations, such as paying suppliers, salaries, taxes, and utilities. Insufficient cash can lead to operational disruptions and harness the company reputation. Even profitable companies can face bankruptcy due to liquidity crisis caused by poor cash management. Second is for optimal utilization. Excess cash, if left idle, represents an opportunity cost as it could be invested in projects, marketable securities, or growth initiatives. Strategic cash planning ensures the right balance between maintaining liquidity and utilizing cash for maximum impact. And third, for dealing with uncertainty. Cash reserve act as an emergency fund against economic downturn, unexpected expenses, or sudden market shift. This flexibility is critical for long-term survival. Here is the key practice for cash management. First, cash flow forecasting. Predicting future cash inflow and outflows to track shortage or surpluses. Second, investment of excess cash. Using surplus funds in short-term investments to earn returns while maintaining liquidity. Third, maintaining minimum cash balance. Ensuring the business always has enough cash to cover short-term liabilities. Next, account receivable. Accounts receivable represents the credit extended to customer, and managing this effectively is crucial for maintaining steady cash inflow and minimizing risk. Why is account receivable management important? First, for enhancing cash flow. Timely collection of receivable ensures a steady cash flow, which is necessary for funding daily operations and meeting obligations. Delayed collections can strain the company liquidity, forcing it to rely on external financing, which increases costs. Second, for reducing bad debts. Poor receivable management can result in non-payment by customers, leading to bad debts and financial loss. Assessing customer creditworthiness and implementing stringent credit policies reduce this risk. Third, for customer relationships. Balancing leniency in credit terms with timely collection ensures customer satisfaction while maintaining the company financial health. Proper communication about payment terms fosters trust and long-term loyalty. Here is the key practice for managing account receivable. First, credit policy design. Establishing clear guidelines on who qualifies for credit and under what terms. Second, aging analysis. Monitoring overdue receivables and taking timely action to recover payments. Third, incentive for early payment. Offering discounts for early payment to encourage customers to pay sooner. Next, inventory. Inventory includes raw materials, work in progress, and finished goods. Efficient inventory management ensures smooth production and customer satisfaction without tying up excessive capital. Why is inventory management important? First, for avoiding stockouts and overstocking. Stockout can lead to missed sales opportunities, dissatisfied customers, and a loss of market share. Overstocking results in higher storage costs, obsolescence, and capital being locked up unnecessarily. Second, for cost control. Excessive inventory leads to increased carrying costs such as storage, insurance, and depreciation. Poor inventory management can also result in waste due to perishable goods or technological obsolescence. But for operational efficiency, adequate inventory ensures an uninterrupted production process and timely fulfillment of customer orders, enhancing operational efficiency and customer satisfaction. Here is key practice for managing inventory. First, inventory turnover analyzed, tracking how quickly inventory is sold to determine whether stock levels are appropriate. Second, just-in-time inventory, reducing inventory to the bare minimum needed for production, thereby lowering costs. Third, demand forecasting, using historical data and market trends to predict future demand accurately and plan inventory level accordingly. So, when we look at these three components, cash, account receivable, and inventory, they all work together as a part of a company working capital. Managing them well ensures the business has enough resources to operate efficiently without over-investing in non-productive assets. Good current assets management also reduce costs like interest on short-term loans or unnecessary storage expense and directly contribute to profitability. But importantly, it helps the business remain sustainable, competitive, and agile in the long run. Next, let's do the analysis. Here we can see I already collect the financial data of Pakuwon Jati annually for 5 years from 2019 to 2023. Here is the balance sheet. Here is the income statement. And the metrics I use for the analysis is current ratio, quick ratio, net working capital, receivable turnover, and inventory turnover. Let's analyze them. First, let's look into the current ratio, which we get from current assets divided by current liabilities. Current ratio measures the company's ability to pay short-term obligations with current assets. A ratio above 1 indicates sufficient assets to cover liabilities. Here we can see there's a decline in 2020, which is 1.98 from 2019 to 0.85, likely due to increased liabilities or reduced current assets. Then we also can see there's a position improvement from 2021, 3.79 to 2023, 5.15, indicating strengthening liquidity and better short-term financial stability. So, in the current positions, a ratio of 5.15 in 2023 suggests excellent short-term liquidity. The company has ample assets to meet short-term obligations, possibly indicating efficient working capital management. Next, let's look into the quick ratio, which we get from current assets minus inventory, then divided by current liabilities. This is a more stringent measure of liquidity, excluding inventory from current assets. Here we can see it dropped significantly in 2020, which is 0.94, indicating challenge in meeting immediate obligations without relying on inventory. Then there's a rebound in 2021, which is 2.47 and steadily improved to 3.59 in 2023, signaling better management of liquid assets like cash and receivables. So, in the current position of 2023, quick ratio reflects strong liquidity even without considering inventory. The company is better positioned to address unexpected cash flow needs. Next, let's look into the net working capital, which we get from current assets minus current liabilities. This is the difference between current assets and liabilities showing operational liquidity. Here we can see a decline in 2020, which is 4.25 million, but rebounded in 2021, 8.43 million, and grew steadily to 2023, 10.52 million. So, in the current position, growth in net working capital indicates enhanced operational capacity, allowing for reinvestment in business operations or debt repayment. Next, let's look into the receivable turnover, which we get from net credit sales divided by receivables. Receivable turnovers indicate how efficiently the company collects upon receivables. Here we can see there are improvements significantly from 2019 to 2022, from 7.70 to 26.19, indicating efficient credit management and faster receivable collection. And also there's a slight decline in 2023, which is 23.65. It's strong, but it's suggesting there are a slight relaxation in credit terms or slower collections. So in the current position, this high turnover reflects robust credit control policies, which helps manage cash flow effectively. Next, let's look into the inventory turnover, which we get from cost of goods sold divided by inventory. Inventory turnover reflects how efficiently the company manages inventory. Here we can see there's a decline in 2019 to 2020, which is 0.87 to 0.44, showing slower inventory movement, which lead to demand issues or overstocking. And also there is a modest improvement in 2021, which is 0.72, but stabilized around 0.69 through 2023. So in the current position, low turnover suggests slower inventory sales or excess stocks, which could tie up capital and pose risk of obsolescence. So overall, the company current assets position in 2023 is strong. The company demonstrates strong liquidity shown by high current ratio and quick ratio, and solid operational flexibility shown by growing of net working capital. Also, its receivable turnover, so its receivable management is effective. However, low inventory turnover could signal challenges in inventory management. This imbalance may indicate the need to refine inventory strategies to ensure alignment with market demand and cash flow optimizations. There's a room for improvement in inventory management, which, if addressed, could further strengthen its financial health. That's all for me. Thank you.